What's up, Gould Miners? Today, we welcome to the program Ben Fraser. Ben is the Chief Investment Officer at Aspen Funds, an investment group specializing in macro-driven alternative investment strategies. Ben is also the co-host of the Invest Like a Billionaire podcast, and in this episode, we dive deep into the psychology and the wealth-building strategies of the ultra-wealthy. Ben kicks off the episode by discussing why we are still in the early innings of the migration towards alternative investments, despite billionaires making the shift decades ago. Later on in the episode, Ben and I spend some time exploring the flaws in our current system and why your financial advisor isn't necessarily incentivized to help you find the best investment opportunities for you. Now, while Aspen Funds is asset class agnostic, the majority of the investments are in commercial real estate and in oil and gas. And to conclude the episode, Ben spent some time discussing some of the tax advantages of investing into alternative investments. These are the same tax advantage investing strategies that billionaires have been using for decades. And in this episode, we dive deep into all of them. This episode is an absolute masterclass in alternative investing. So whether you are brand new to alts or you've been investing in alternatives for some period of time, there truly is something in this episode for everybody. So without further ado, everyone, let's welcome to the show, Ben Fraser.
The Gould Mine podcast.
Ben, welcome to the Gould Mine.
Hey, thanks for having me, man. Looking forward to it.
Yeah, dude, I'm super excited to chat with you, and you have a quite extensive background, right? Especially in the alternative investment space. You are the CIO of Aspen Funds. Give me a high level overview of what Aspen Funds does, so that the audience kind of gets some context here as to what you do.
Yeah, sure. So Aspen Funds, we are a private alternative sponsor. So we operate private funds and syndications in the alternative kind of space. These are all not publicly traded, but private equity. We have nearly 1,000 LP investors, high net worth investors who've been going over 12 years now, and really have about 4 key verticals that we operate in a variety of asset classes on the debt side, both single family and commercial. We also own and operate a lot of multifamily and real estate. We develop industrial, large-scale industrial buildings, and then we also invest in oil and gas opportunities. So those are kind of the 4 verticals. My role is Chief Investment Officer at a partner, and really responsible for all the capital markets, the deal flow, asset management, and also doing some content creation when I have free time, which feels like less and less, but still love doing these kind of things. And we have our own podcast and other content as well. So yeah, it's a little bit of what we do.
That's awesome, man. Yeah, and honestly, there's a couple directions that I could take it because you've got such a diverse background. But what I wanted to focus on first was, the 4 verticals that you work in. As the fund, are you also the operators of all of these silos, or are you investing into running a fund of funds model where you're investing into some of these other operators?
Yeah, great question. And it's awesome that you asked that, because I feel like 5 years ago, no one would even know what that was, right? The idea of fund of funds or feeder funds. So the simple answer is we are the lead operator in almost every deal that we do. The only exception would really be the oil and gas, because it's a pretty different vertical. So we've partnered with a firm that's been in the space 40 years, an institutional level firm on the acquisition, asset management side. And then we really helped on the capital formation, the strategy, the fund, the hedging, acquisitions, and those kind of things. So more kind of big picture, but the geology, the engineering, we need experts that know what they're doing there. But every other case, we're the lead operator. We operate our own funds. And we actually work with about, we actually tallied the number yesterday, about 30 fund managers right now. So it's actually, we started going down that path, creating the opportunity for feeder funds to work with us to help us continue to scale, and then allow newer capital raisers to get the benefit of our track record, which is over a decade now, and be able to leverage that to their benefit, and then kind of everyone wins in that scenario. So we work with a lot of fund managers, a lot of feeder funds, and I think it's a great model as well.
Yeah, that's awesome, man. And I was just going to ask because, these are all now, aside from oil and gas, these are all in the commercial real estate sector, right? But they all have their individual kind of like their underlying foundational knowledge requirements, right? And so how, as the chief investment officer, have you like been able to develop the foundation, like the breadth of knowledge necessary to kind of like make educated decisions across a myriad of like different asset classes like this, or different, different sectors within the commercial real estate asset class?
Yeah, it's a great question. I've been, in this sector and in kind of business for about 15 years.
Yeah.
I got a finance degree, an MBA, studied, these kind of things in school. And then really, I think that the early parts of my career, I worked for some large boutique asset management firms that were doing publicly traded alternatives. So my exposure to alternatives was, right early on, but more from the publicly traded side. They had some closed-end REITs that they managed, but got a flavor for things outside of just the S&P and, set it and forget it strategies. And then really spent the core part of my early career in commercial banking. So was a underwriter and a lender for several years, structuring, business development, managing loans. And so my background is really, I'm trained on the debt side of things.
Yeah.
Which makes the equity a lot easier because you only look at the downsides, right? If you're as a banker. And, honestly, why I transitioned out of it was I was just sick of not being able to have any fun of what actually happens if this works, right? I don't get any benefit. It's only downside. And then really saw about 10 years ago, really 8 years ago is when I joined Aspen, the early innings of this massive wave and shift to alternative investments from the retail channel. And it felt kind of like the early days of, .com, and I was still somewhat younger then, but had enough, awareness to see the transformational impact and power of that. And it feels like even though alternatives have become more popularized, have become more, people understand them, a little bit more intuitively than they did a few years ago. It's still a very small subset of most retail investors' portfolios. And I think we've got, 5-10x growth of capital coming into the private markets over the next several decades. I mean, I just think there's going to be a huge wave of capital for a lot of reasons we can get into. But that really excited me. And then just with my skill sets and what I wanted to do, which was ultimately be a business owner and, grow something that I had control over and could build for the long haul. It's worked out well. And I'm one of 3 partners. I'm the youngest by about 20 years, and gives me a lot of perspective, having their wisdom of many cycles, many investments.
Yeah.
But I got a lot of horsepower that I bring to the table to help grow things.
That's awesome, man. Well, you mentioned that you kind of got it in the early innings where you saw this wave of money come into the alternative space. So you said about 8 years ago is when that shift started to happen, right? Or give or take. When do you think it was coming out of the last recession that we really started to see this, or like when did that like transition or like that shift in investment strategy really start happening, and why do you think it started happening?
Yeah, it's a great question. And it's interesting because I think a lot of people, the idea of an alternative investment for like an average retail investor, they go to the financial advisor, like, oh yeah, we'll get you some REITs, maybe we'll get you a little bit, a small percentage into gold, and you still have mostly 60-40 bonds or stocks bonds, and we'll get you a couple, percentage points in these other things just to have exposure to it and diversification. But the problem is, over the past several decades, we've seen the the real fissures of the 60-40 portfolio kind of come to bear, because what's happened is most of the public markets, whether it's equities, bonds, commodities, they've all become much more correlated than they have 20 years ago. And normally the idea was, hey, if stocks are down, bonds are up, and vice versa. So if I have some exposure to both, it's going to reduce my volatility. And over time, that's going to benefit me from diversification. The problem is all of those asset classes are moving much more in concert than they ever have. Like, we can prove this mathematically. It's just not me just making stuff up. This has absolutely happened the past 20 years. And so what's happened is we all, if you believe modern portfolio theory, right, which is the foundation of our financial, planning system, which at the end of the day ultimately says diversification provides you the most free lunch you can get anywhere, right? If you have some little diversification, you set yourself up for much more success than if you didn't, right? We can get into some of that if you'd like, but the problem is you can't get diversification in the public markets unless you go outside, right? And that's, I think, part of this feeling of like, man, there's got to be something else that we can have access to as investors to really get the best risk reward kind of pie, right? And in tandem with that, in 2012, the Jobs Act substantially and foundationally changed the regulations around private alternatives, right? Before then, if you're going to invest in a private alternative, you could only invest in something if you had a prior relationship with the offering sponsor and a substantial relationship. I mean, you couldn't have just, met him at a coffee shop for 5 minutes and that counted. It had to be substantial. They had to understand your financial situation. And so the reality is private alternatives, private equity, private real estate, these hedge funds, all these different kinds of alternatives have been around for a very long time. This is not a new thing that's happening, but what's changed is the access, and it's fundamentally changed because what's now happened since 2012 is the regulations now allow sponsors like Aspen Funds, like us, to go and directly market to accredited investors, right? So that's what I think was really a monumental shift. At the same time, the market was kind of feeling, the existential question of there got to be something else other than what I'm doing.
Yeah.
And then, we've done a ton of research. It sounds like you have as well, on what the ultra wealthy investors are doing. It's the whole foundation of our podcast called Invest Like a Billionaire. It's invest like the ultra wealthy, and what they're doing and have been doing for many decades is investing large allocations into private alternatives, and large to the tune of 50 to 60%. If you look at the averages of the foundations, the endowments, the kind of family offices, if you're looking at their average allocations, generally they're at least 50% into privates. And it's totally different than the retail. The retail investor is maybe your 5% in alternative investments.
Yeah.
And so that's where I really think the early innings, it only happened in 2012. So that was 13 years ago when we're having this conversation. And it's definitely seen a big shift towards private markets, but it still feels very early innings to me.
Yeah. And you mentioned that, the average American has maybe 5% in alternatives. I don't even know if it's that, to be honest, because we're talking average American, right? Like, I think the statistic is, Ben, that that 95% of the average American's investment portfolio, which, I don't even know if the average American has a significant or substantial investment portfolio, right, is invested into the stock market.
Yeah. It wouldn't be surprising to me.
Yeah. Yeah. And to speak to the stock bond correlation, I think I read recently that it's at a 75-year high, the correlation between stock and bond. So
yep,
the diversification that you get or that you're supposed to get just isn't there anymore. Right. Yeah. But what I also find peculiar, and I don't know if you find this strange too, is that real estate is considered alternative investing.
Right.
Isn't that weird? Like,
yeah,
it's like considered alternative, but it's like, isn't that how, because at least, my tax guy, and he's a big real estate guy, but he used to work at Ernst & Young and, was a corporate accountant before he's, kind of got into the, the commercial sector, like the private sector, right? But, he's like, dude, like 95% of the people out there that I do taxes for, that are, have a net worth of over $1 million are either in real estate or they own their own business, right? Like no one's made their money from the stock market. Like no one's made significant wealth in the stock market. Yet we've been like fed this like propaganda almost, right? From like Wall Street financial advisors. Why do you think that is? And like, how do guys like me and you kind of like break that cycle?
I think having conversations like this, right? I think, this is, maybe the 10,000th conversation of people having these conversations on podcasts, but I think it's still, this is going to be mainstream, right? Because the technology is shifting that way. The access is absolutely shifting that way. I've been seeing this for almost a decade, right? And it's like been incremental, but it feels like these leaps and jumps have gotten bigger, as we continue to accelerate, I think, this shift because of the awareness, because of the access now. But you're exactly right. I think what was so interesting to me as I've dug into this whole world is Wall Street is not out necessarily for your best interest, right? And I say that all the time because I think most people understand that intuitively, right? It's like, this is what I have to do. And I know like the system rigged against me, but I don't have any other options. And, Dave Ramsey talks about investing in the stock market. So that's just what I'm going to do. I'm going to max out my 401k and I'm going to, try and save 10% of my income and wait till I'm 65 years old and hope to God that I have enough money that I can live off of and have 4% principal drawdowns every year. And, meanwhile, we're, average age of the average human in developed countries is rapidly increasing. So all those financial models might be broken already. That's, it just feels like you're already at a disadvantage and the whole system is set up for asset gathering. And this is what was so complicated to me as I was 8 years ago, come in the space with some great investment opportunities. I was responsible for the capital raising at that point. And so I'm going and talking with where the money, well, RIAs, registered investment advisors, they're the ones that all, the rich people go to tell them what to invest in. So I'm like, oh, these guys are going to love what I have because it's way low volatility, really strong yield relative to what you can get in the stock market, backed by real assets. I mean, all the reasons we love real estate. This was on the debt side of our business, so even more, lower risk.
Yeah.
And I'm thinking this is a no-brainer. You start having these conversations. I talked with probably a dozen or so investment advisors, and the answer was the same. It was, this sounds really cool, but it doesn't really fit into what we're doing. And they kept throwing all these reasons that they couldn't do it. And as I started to dig into the follow the money, follow the incentives, they're actually incentivized against alternatives. Think about it this way. One, they only get paid on assets that they manage. It's very difficult for our advisors to charge AUM fees on private alternatives, right? So they're already disincentivized to allocate money away from what they get paid on to something they don't get paid on. And then similar to, like I said, my background's in banking, right? Where you only really have downside risk. Advisors also really only have downside risk, right? The risk of liability on them if they make a poor decision or they make an investment or recommend an investment that loses money is extremely high reputationally, whereas they don't necessarily participate in the upside if it actually works out. So it creates this skewed risk perspective where they don't want to take any risks because they don't benefit from it. So then the natural conclusion is, well, let me build the most simplistic portfolio I can that I can scale because of its simplicity. And I'll just charge AUM fees on that and we'll call it good and no one will know the difference. And that's, I think, a oversimplification of how the industry has evolved and got to where it's at. But I think that's ultimately how all of the structures are set up now, where, traditional Wall Street, publicly traded investments, the S&P index funds, these are in stark contrast to the models of private alternatives and private equity that you can't get from an advisor. So, thankfully, there's a lot of advisors that we work with that actually see the benefit of it, and they've actually structured their models entirely differently for their clients. And it's been really interesting how it's kind of shifting, but it's a very small subset of the overall RIA channel. So I think it's going to happen. I mean, because you're also seeing on that side of the world, the RIA side of the world, it's all stocks, bonds, simple index funds, set it and forget it. Hey, don't worry that your portfolio is down 30% because, it's always usually going up, and, over a long enough time horizon, you'll be fine. But, that doesn't help when it's down, right? And I think the race to zero is a concern for a lot of these advisors because they're not really adding a lot of value, right? A lot of the robo advisors, a lot of these standard index funds that are, really low fee, it's driving a lot of value out of that model. And I think advisors are being forced to wake up to this whole other world that's actually probably just as big as the public markets. The private markets are just as big as the public markets.
Right.
And I need to figure out a way to get my retail clients exposure to that, or else I'm going to lose them because the world's shifting that way. I'm making less fees on the other stuff. I'm not providing value. And the retail investors want it now.
Yeah. Wow. I agree with everything that you just said. And to piggyback off of that, you've got your RIAs, which is honestly, that subset in and of itself, I think is higher quality overall than like your cookie cutter, big box brokerage firms, right? Because you've got all the finance. So the majority of Americans, they're not going to RIAs, right? They're going to your standard, Schwab, Merrill, all these guys, right? They're going to these big box firms because that's what they see, and that's what they're commercially fed, right? And those guys have even less incentive because they have so many regulations placed on them by their companies, right? Like the regulations on these guys is so high. And I actually have a couple of buddies that are financial advisors, and they are in handcuffs, man. Like their flexibility and their ability 100%. To be creative and like get people, like they have zero freedom basically, right? To help their clients.
Yeah, because they're generally going to be limited to offer their investors only the products on their platforms, which a lot of times are their own products, right? So it's not, it's even further limited. You're exactly right. And they got way more scrutiny, a lot more eyeballs, way more risk because they're big. And it is a heavily regulated industry. So it's challenging. It's very challenging to navigate all that and serve the client.
Yeah, 100%. And I think the other thing too is that, it's funny because like in my YouTube videos, I have to like, on the one hand, I often like tell people like your financial advisor isn't giving you access to a lot of these opportunities, right? So on the one hand, I let them know like your financial advisor really isn't working in your best interest the majority of the time. Also, my standard like disclaimer is make sure that you talk to your financial, right? Like we don't have, you see what I'm saying here? Do you see like like
it's a catch-22. It's very,
it is
very
so
circular
because, honestly, and my buddy, who works at Merrill, and actually like, he's one of the good ones, right? Like he's actually like really, really smart, and for the most part, like tries to do his best within the confines of what he's given. But it's this constant, he's like, I want to be someone's personal CFO. That's real. I mean, like if you think about it though, like how many people out there are working on behalf of the consumer and not in some way, shape, or form acting on their own behalf. Because if you had somebody who was truly a fiduciary and had, their incentives are not necessarily tied to like, you got to choose from this bucket or whatever, and truly working on behalf of the client, like how many more people would be exposed to these kinds of opportunities? I think like the answer would be a whole hell of a lot more. I don't know what the answer is, but it's certainly not what we have right now. Like in terms of how do we work on behalf of the consumer, right? Like how do we put the consumer's interest ahead of everyone else? And how are we going to like create a system that doesn't play favorites with, with what Wall Street has to offer? Because clearly like that's what's happening right now. Right.
Totally.
I don't know. It's weird. It's weird, man. I am curious.
Too, not to die on, on this hill here, but, I also believe there are really good people in the financial advisor space that want to do well with the clients. So I don't want to throw them under the bus because I don't think that's truly the motivation is to screw all your clients over, right? That's silly. But the way the system has been set up is it does not help financial advisors truly help their clients. I think that's the point, right? Because what happens is I work with a lot of investors that are high net worth investors that have financial advisors, and they'll send a deal to them. Hey, what do you think of this deal? And the financial advisors really have no idea, one, how to do due diligence, two, how to truly understand risk and return, because they're not taught that in the CFP. The CFP is very different than another designation of like CFA or CAIA that are more focused on deals. And again, they have the risk. They carry the fiduciary risk. So you have lack of understanding, lack of knowledge, and you have disincentivization because of the risk reward. It's generally going to be an automatic no, right? Not to include all the compliance and other stuff. Like I know an RIA who believes so much in alternatives. He puts his investors in it. He doesn't want any compensation from me because legally he actually can't. Yeah. And he doesn't really charge his clients all that much more, but he gets so much flack from the regulators because he puts his clients about 30% alternatives. And the regulator's mind is like, that's so risky and so crazy. But he's like, well, look how it's done relative even to the public markets, right? It's like, how can you argue that this is crazy, right? In his mind, it's so obvious, but most advisors aren't that way. And that's what's so fascinating about this whole, again, transition, because I do think it's all coming to a head, right? The diversification is not working. Race to zero for investor fees. Retail investors are waking up to the power of it, and they want more of it. And so they're having to shift the models. And so that's why I feel like we're at this kind of still early innings. I mean, I've been in this for almost 10 years, and, I was worried I missed the syndication boat a couple of years ago, right? But it's just still early innings. And so anyone that's out there is like just getting, exposed to it, interested in it, like dive in more, because there's still so much momentum and this like tidal wave shift toward it.
Yeah, 100%, man. And I could not agree more. It's an exciting time for sure. It's a really, really exciting time. And it's exciting not just for guys like me and you, right? Because like we're on like the GP side of things, right? But like also for investors specifically, like it's an opportunity to think outside the box and an opportunity to like really, level up your game. It's interesting because like I come from an education. I don't know how, obviously you've gotten to a point, Ben, where it sounds like your fund's doing really well. You've probably got a lot of referral, business coming in. You've got a lot of people kind of coming through, presumably other investors that have worked with you, et cetera. But like, I'm earlier on in my journey, and I really kind of prioritize like an education first model, right? Like, hey, I want to educate, because like the majority, I've told this story before on my podcast, but I'll say it again. The moment that woke me up was I was actually having a conversation with a real estate developer here in Silicon Valley. So I'm in San Jose, California, and we were chatting. He did like luxury single family developments. developments, right? Like onesie twosie, houses, not like large scale developments or whatever. But he also he owns 40 rental properties in Phoenix, Arizona, right? So here's a really, well-to-do, smart, plugged in real estate guy. And I asked him if he had ever considered investing in a real estate syndication. And he says, "What's that?"
Right. The guy's already in the space. Has no idea what you're talking about.
Exactly. And that was the moment, Ben, where I realized I needed to do something about that. Right. Like I saw an opportunity there. Right.
Yeah.
From an education perspective, because I'm like, this guy doesn't know. Imagine all the tech bros here in Silicon Valley. They had no idea. Right.
100%.
Now, getting them to move from knowledge to action, that's another, that's a whole another hurdle, because people are comfortable where they're at. Right. And I think there's a certain comfort level. And so, kind of piggybacking off of that though, like, how have you managed to kind of like get people comfortable, right, with the idea of investing in alternatives? Because it is a foreign thing, right? Like there certainly has to be kind of like a mindset shift or hurdles that you kind of have to kind of get over in order for them to feel comfortable investing with you, right?
Yeah. Yeah. No, it's a great question. I think we've encountered the same things, right? Because the system is set up against alternatives, right? Whether there's a big conspiracy or not, that's the way it is. So we've got our work cut out for us to help open people's eyes to it. But I think I love the education first idea, because really what I believe, and the reason I love doing these kind of podcasts and why we even started our podcast, was I want people to take control of their money, right?
That's it.
And what really bugs me, and I saw this with like my in-laws, right? They're the classic, American household that went to school to be a doctor or study for 12 to 16 years, worked, 50, 60 hour weeks for 35 years, hated every single minute of it. Now has enough to retires, gives it to financial advisor, but literally wants nothing to do with it. It's so stressful to think about.
Yeah.
He doesn't want to even think about it. The financial advisor telling him what to do. But the flip side is having control over your money, right? People work so hard for their money. They work so hard for their income.
Okay.
And how much investment do you make into that? Right? You go to school, you have education, you do different networking and events, and you spend your first years just grinding, trying to figure things out, trying to create value for the hopes of making more money. Well, you work so hard to make your money, and sometimes several decades to get to a meaningful income, that then you just blindly hand the keys over to the kingdom of your wealth to somebody else, who's less educated than you, who has disincentives, who wears a slick suit, to just tell you what to do with that, because the system's so complicated you can't figure it out. And so I say all that to say, my hope is that, and I've started to see a lot of this happen, where it's to take control of your money. Like these retail investors are smart, right? The system is set up to make you think it's very complicated, but it's not that complicated if you really break it down. And so I think education is so powerful, because it unlocks how do I get from A to B, right? Because it feels confusing. It feels like this black box, and that's really not the case. There are some things you got to learn. There is some vernacular you got to pick up. There is, a lot to learn on the due diligence side of how to make good investment decisions. But that's something you're always going to be growing in. And I think that effort is really going to help a lot of people, right? What you're doing, what people like us are doing to help further this goal, and just ultimately it's to benefit the end investors, the end clients. And we've had success doing that. So we've had our podcast and been doing that for over 3 years. We're also writing a book of the same name, and really wanting to get people feeling confident to take control of their wealth. Because here's the real factor. We have some examples in the book that we've written. the power of getting to a place in your net worth where the money that you earn in your investments starts to compound and actually significantly outpace the earning from your career, right? And this is what's kind of crazy. The early parts of your wealth building, the primary driver of your net worth is your income. Once you hit a certain point, that's usually a few $1,000,000, and you're actually having success, having a true diversified portfolio with alternative investments, with some great tax benefits. All of a sudden, the compounding engine of your investments start to earn you more than your earned income. And as that, you kind of extrapolate that over time, the power of being a better investor and earning just a few percentage points more than the average, right? Which is not that hard to do if you allocate to private alternatives. All of a sudden has a multiple effect on the earning potential from your investment dollars, which is the end goal, right? Be able to make more money on the dollars that you don't have, that you've already earned and are working for you, than having to trade your time for maybe something you don't enjoy doing to get a heavily taxed income, right?
Yeah. And before moving on here, I just have to acknowledge what you just said, which is the majority of, think about the average American who makes over, let's just say 200 grand a year, right? Which is the standard for accredited investor. Household is 300, but let's just say the average person who makes over 200K, one would assume that almost all of those people invest the majority of their day into what they do.
Yep.
Right. They spend a lot of time making the money. And so where do they find the time to actually figure out, what do I do with this money? Right now, you've got the guys who, the control freaks, right? They like to go on Robinhood and they like to do their trading or whatever and do all that stuff. But that's a small portion of it, right? You think about a great example, one that I love to use is a physician, right? Like a doctor. I actually just spoke to her name's Andrea. She's a physician's basically life coach for physicians, right? So, and talking to her, it just validated every single one of my theories, which is they're all stressed out. They have way too much on their plate. They have zero time to think about investment strategy. Right. And so exactly what you just said, they hand over the keys to someone that's actually probably less qualified to manage their money than they are, if they actually invested the time.
Yes.
Right. Into figuring out what to do with that money. So yeah, man, it's
in the investment of time doesn't have to be equivalent to what you spent for your career to learn your trade or skill, right? It could be a fraction. I'm talking less than 10% of the amount of time and effort. It's not this monumental task of, it's going to take me 10 years and I got to get pass these tests and do all this reading or whatever it is. That's not what it is, right? It's just making little decisions, taking little action steps, listening to podcasts like this, reading books on it, engaging in, conversations with sponsors and starting to make some of these investments and start small, right? Keep, play with a small amount of chips on the table to start and just be able to learn over time, but having a disciplined plan to go and learn is, I think, really, really the key, and realize it's not going to be even close to the amount of effort that you may put into an education or a degree for your career.
Yeah. And that's why, it's up to guys like us, though, to be able to kind of consolidate all that knowledge, right? And then deliver it in chunks that are digestible, where it's they don't have to go searching in a million places to go find, needle in the haystack sort of thing. But that's why I love what you're saying, man, because I could not agree more with everything that you're saying is just 100% on the dot. You glossed over this, but as we start to wrap up here, because we're coming up close to time, you glossed over the tax benefits thing. But this is something that I think a lot of people don't necessarily have a comprehensive understanding of what tax advantages are actually available, especially in commercial real estate and oil and gas, right? So you're in two of probably the highest tax advantaged asset classes. So kind of walk us through what advantages a limited partner like an investor would be able to kind of like realize through investing in some of your funds.
Yeah, sure. So, got to give the caveat, I'm not a CPA, so you got to talk to the CPA to make sure it's fit your situation. But, this what's so cool about it is this is all legal stuff. This is all in the IRS code that has been around for a long time. And when you kind of start learning about it, you're like, WTF, why haven't I been told this?
Yeah.
Like way sooner? Because this is one of the biggest wealth hacks potentially ever. Because you think about if you can reduce your taxes by say 20, 30% in California, maybe more than that, right? And defer that and be able to compound faster on that. I mean, we all understand the power of compounding, right? If you can compound tax deferred, it's a massive driver to wealth creation, like massive. Sure. And so one of the cool things with real estate, and I'll get to oil and gas in a second, is you have these kind of paper losses, right? So the tax code says that on a straight line depreciation calculation, depreciation is just the usable life of the asset depreciates. It goes down in usability over time because of natural wear and tear. And so the tax code allows you to get a benefit of giving you what's called a paper loss. So it's usually on a 27 and a half year straight line curve. So the value of the asset divided by 27 and a half, that's the average depreciation loss that you can net against the actual cash income coming to the property. Well, the cool thing is the tax code also allows for some accelerated or bonus depreciation, right? And there's hope that these rules that have kind of been starting to phase out actually kind of come back with a vengeance. We'll hopefully hear about that soon. But it allow, exactly. Everyone's crossing their fingers. It allows you to kind of compress the time period of those losses to the front end of that curve. I mean, instead of over 27 and a half years, maybe you compress 50% of it into the first year, 20% into the next year, and then more there on there, so forth. And what that does is many times will actually produce losses in excess of the income being generated from that investment. And then what you can do with those losses is they can carry over to other passive income that you have from other investments. And also many times carry forward into future years if you can't use all of them. So it creates this kind of tax shelter. So you think about, your earned income, it's the worst kind of income to generate because it's really hard to protect against paying taxes on, right? But investment income, there's lots of ways to push off and defer and sometimes eliminate taxes altogether on the income. And so that's one of the powerful things. As a limited partner, you get the benefit of that. If you can find a way to become a real estate professional, and again, I'm not an expert, though I am one of those real estate professionals. It's not a thing you do. It's just tax code or a thing that allows you to now use those losses against all your income if you are actively working in the real estate world.
Yeah.
But there's also a short-term rental loophole that you can do it for a much lower barrier to entry by managing short-term rentals. There's a whole set of rules around that actually allow you, again, to use those passive losses against earned income. And I have a buddy right now who makes probably $500,000 a year as an insurance broker and getting creamed on taxes. And I'm like, dude, go buy a short-term rental and it might not eliminate all your taxes year one because you got to start generating more losses. But within a couple of years, you could be eliminating almost the majority of your federal income tax and allowing all that capital to go back into buying more properties. And all of a sudden, you've just unlocked 20, 30% more cash that you keep from the cash that you earn.
Yeah.
Invest into properties to create this massive snowball of losses. And there's depreciation recapture. There's other things you got to understand the back end that you got to pay the piper eventually. There are ways to continue to defer, which we won't get into. But it's a massive, powerful wealth building tool. And oil and gas is very similar, though in some instances it's actually more powerful because some of these losses are can be used against active income without having to qualify for a special designation like a real estate professional, and many times are not recaptured. So they are straight tax losses that aren't deferrals. They're just true reductions of your income.
Yeah, that's amazing, man. And that's something that, I think, again, a lot of people, they kind of gloss over in their investment strategy. They don't really think about tax advantages as a part of the investment strategy. They think of like, what's my return? But there's a big difference between what's my return and what is my tax adjusted return, right? And so on a real estate investment where you're getting, a lot of that income tax free, your index fund would have to outperform that income by like an additional 20, 30% for it to actually be equivalent, right? And show me where that's happened consistently, because it'd be hard to do if you've got a good performing real estate investment versus money in an index fund, or you've got your own portfolio that you're managing yourself. It's hard now. Last couple of years, I would say that there's probably some people out there. You got the stock bros that are saying, "Oh, I rode NVIDIA all the way to the moon." It's like, good for you, right? Like there's always going to be those outliers, but
for sure.
But yeah, man.
But again, going back to what the billionaires do, the ultra wealthy, and this is something we talk about in our book. A lot of people get frustrated by the fact that the billionaires don't pay a lot in taxes, right? And it's like, oh, Jeff Bezos, I forget the exact stats, but we listed out of like all these people that and the percent of income tax they actually pay based on their earnings in the year. And it's like 5%, 3%, 1%. Yeah. And it boils people's blood. They're like, well, they're already so flipping well off, and now they just pay less taxes. Like, this doesn't seem right. But you can get pissed off, or you can learn how to benefit from it yourself, right? Because they're not doing anything that's breaking the law. This is how it's set up. And so figure out how to get on the right side of it and do what they're doing, right? Model that. That's how the ultra wealthy think is. It's not what I earn, it's what I keep, right? You have to add the tax adjusting filter, like you just said, into every calculation you're making, because that is, again, one of the most powerful levers. If you can figure that out, it's a massive booster rocket to wealth building. Massive.
100%, man. 100%. And honestly, I could chat with you about this stuff for hours, man. I would love to have you on again. I think, we share a lot of the same perspectives, a lot of the same kind of philosophies. So, yeah, man, it's been a pleasure having you on. And before I let you go, though, in traditional Gould Mine fashion, we're going to have you leave the audience with one final gold nugget. Take it away.
Oh, man, you didn't even prep me. Dang. Yeah, gold nugget.
It was on the email.
Oh, was it? Okay. You did prep me. I just didn't read it. Yeah, good question. I mean, I think first thing that comes to mind, because I'm a man of faith and, I strongly value values. I think at the end of the day, you need to have a purpose for what you're doing, right? Because we're talking about making more money, keeping more money, and all stuff. But at the end of the day, you have to have a reason for that, because money's not going to fill your bucket. It's not going to bring you more happiness. We all know that, although we don't believe it. No one believes that, even though it's stats say. And, first things first, right? You got to have purpose. You got to have values, and do these things, but have a real purpose behind it, right? And for me, I got 5 kids. I'm a big family guy, and
that's awesome.
I'm having a lot of fun doing the business, but I don't want to do it at the expense of my family, right? And so there's always trade-offs, and know where that's at for you, and don't let something that seems to be a shiny object or the ultimate goal of success steal away from, the journey and the most important things, the relationships in your life, faith and family and those kind of things. You don't want to put it in front of it. So little bit, kitschy there for you maybe, but I truly believe that. And I see people that have success and they're not happy. And it makes me really sad because I'm like, you sacrificed everything for this and it wasn't the right thing to sacrifice for. So I think it's important to have that in these conversations,
Yeah, 100%. And I think it's a great way to to cap this, right? Because we've been talking, all business, all kind of like, strategy, financial, investment strategies and everything. But you're right. Like there's, I couldn't agree more, man. I couldn't agree more. Ben, this has been awesome, man. It's been a pleasure having you on and look forward to having you on again.
Awesome. Thanks, Dan. It's really fun, man.
All right.